How do banks decide what to lend you? In today's video, we're gonna cover affordability, a couple of fancy terms as PITI and DTI, but more importantly, we're gonna teach you in less than 10 minutes how can you yourself calculate your monthly payments. And don't worry about if you don't understand anything right now, because we're gonna dive into this new video now when I'm gonna explain it in detail. Really excited about you guys tuning in. For those who doesn't know me yet, my name is Raja Tayyip, real estate broker, real estate investor of 15 years. If you want to learn more about real estate related topics, subscribe to our channel and let's dive into our video. So one of the most famous real estate saying is location, location, location. My personal favorite is affordability, affordability, and again, affordability, right? I'd like to live on Central Park, penthouse overlooking the beautiful park. I'd love to drive a Ferrari, but can't afford it, right? So my main goal is to educate you about your affordability. Now I'm going to teach you a very simple calculation how you can yourself in less than 10 minutes figure out exactly what would you qualify for. So first fancy term called DTI. What does it stand for? Debt to income ratio. Why is it important? Because all the banks, they're gonna look at your debt to your income ratio. And for instance, conventional financing wants you to be somewhere in the vicinity of 45%. So how do we determine your debt to income ratio? It's a simple math. So the very first thing, we look at your income and we always break it down to monthly. So let's say we have a husband and wife combined income of $90,000. That's gonna give you a monthly income of $7,500. So yearly income, $90,000, monthly income, $7,500. So we figure out the income. Second thing we gotta figure out what's your monthly debt, and that's gonna divide into two parts. It's gonna be your personal debt versus the PITI. Second fancy term. What's PITI? PITI stands for principal, interest, tax, and insurance. So that's one part of your debt, and second part of your debt is gonna be your personal debt. So for instance, let's say husband and wife, $90,000 income, $7,500 monthly income. They do own a car. They lease a car, they finance a car, it's $500, number one. Number two, they have a credit card debt. Minimum monthly credit card debt, let's say $100. And let's say they're still paying down their student loan. So now we have $100 for credit cards, $500 for a car finance, $200 for a student loan. Total personal debt, $800. Now let's figure out the PITI. So let's say, for instance, they're looking to purchase a single family home, $500,000 purchase price. They have 20% down saved. That's $100,000. Therefore, the loan amount will be $400,000. And average interest rates of today, 3.75%. 3.75% on $400,000. That's $1,852. So from the PITI, principal and interest, PI, it's going to be $1,852. Second thing they're gonna have to pay, the T stands for tax. Tax, let's say on average, $4,800 a year. Monthly, we're gonna break it down to $400, and they're gonna pay insurance. So let's say homeowners insurance, that stands for the I. You got it right, that stands for the I. Insurance, $1,200 a year, monthly, $100. So we got the PITI now. Principal interest, $1,852. We got the T, taxes, or $400, and we get $100 for an insurance. So the PITI now is $2,352. So we add the PITI, $2,352, with the personal debt, which is $800, and that's going to give us a grand total of $3,152, right? So now we know their income, which is $7,500, and we know their monthly debt, which is $3,152. So what do? We take the $3,152 and we divide it by the monthly income of 75 and we multiply it by 100. And as you can see here on the board, when we've done all the calculations for you, their debt to income ratio is 42%. Green light, they do qualify for conventional financing. Because remember what I said at the beginning, a conventional financing, they want you to be in the vicinity of 45%. This family, in this particular scenario, it's at 42%. How long did it take us? I think 8 minutes. So in 8 minutes, yourself, you can figure out exactly what you qualify for. Pick the property of interest, take a look at your debt, do a very simple calculation. How do you calculate The mortgage, very simple. Go to Google, put mortgage calculator, put the loan amount of $400,000, put the current interest rate. That's going to give you the principal and interest. I understand it's a lot. I understand I go fast. If you have any question about the calculation, leave a comment below. We're going to also put the formula in the link so everybody can download the formula how to calculate this on your own. Okay, so that's a number one topic covered in the affordability, how to calculate your own monthly payments. Number two, we're going to jump into some slides from the experts and the economists. So first slide I'd like to bring in is my favorite, a housing affordability index. So here on the slide you can actually see the affordability going all the way back to 1990s, right? And the higher the number, the more affordable it is to own the property. So this is so interesting, right? Right now, today, the affordability index is at 152, which is higher than from 1990s all the way to 2008. So basically, it is more affordable now to purchase a property than from 1990s through all the way 2008. Yes, of course, after the Great Recession, after the market crash, the prices had dropped over 20% depending on the market, and the rates were low as well. So then the affordability index was much better. But when you look at the affordability index today versus 1990 to 2008, it's pretty staggering how affordable it is now to own a property. Second slide I'd love to share with you is the increase of the buyer purchasing power, right? So there's three market factors that affect the affordability. Number one is home prices. Number two is mortgage rates. And number three, it's your wages, right? So the home prices had gone up 5.7% on average. That had actually decreased the buying power by about $21,300. The mortgage interest rate had also reduced by about a 0.85. That actually increased, that had a very positive impact on your purchasing power of $40,200. And the wages are up as well, on average about 1.5%, that added another $5,600. So basically total impact on purchasing power was $24,500 for the 2019, and the same trend is expected going into a 2020 with these obviously low interest rates, right? So to remember, market factors are three: home price, interest rates, and your wages. Now, last slide I'd love to share with you. It's a message from Greg Ugalde, who's the chairman of the National Association of Home Builders, who had basically shared with the public, with mortgage rates at historic lows, consumers are experiencing greater buying power and increased affordability. Right, so that's a great message from the chairman of National Association of Home Builders that the affordability is on rise. Actually, I have one more slide. Sorry, guys. But you're gonna love this one, right? So this one is a historic data for the Mortgage Credit Availability Index, right? This index shows you, look at before the Great Recession, right? It was right below 400. Basically, the guidelines is to apply for financing. And then they lose all the guidelines, the subprime market, it came up almost to a 900. And then the Great Recession, the crash happened. And look how tight the guidelines became, right? It was slightly above 100. The great news is we have learned from our mistakes, and from 2008 all the way to 2019, we have kept the guidelines, restrictions very strict, so only the right people will get a financing, right? You've got to have an income, you've got to have a credit, you've got to be able to pay for a monthly payment, you've got to be in position to qualify. So that's a good to see that the Mortgage Bankers Association shared with us this credit availability index of the guidelines in terms of getting the financing. Now, this will pretty much wrap it up in terms of the affordability. I know it's a heavy topic. I know we have covered a lot of things. If you have any additional questions, please comment below. If you're looking forward to a more real estate related information, please subscribe to our new bottom, and I can't wait to see you on the next one. Take care now. Bye.